Imagine a system like an economic operating system that we just assume is functioning correctly. But underneath it, the architecture is basically leaking voltage everywhere. And, most people just pretend that nothing strange is going on until suddenly something breaks. Everyone panics and everyone asks, how did this happen? And that's basically how I want to start this. Because there is a narrative circulating online, maybe you've seen it, that Bitcoin should already be worth several $100,000 per coin, but it isn't. And the explanation people gravitate toward is manipulation, specifically banking manipulation, institutions suppressing the price. Now, I don't know if that's true, but what is true is that the structure of incentives reveals something pretty interesting. Like, look at what people are doing. You have individuals revolting online, talking about JP Morgan shorting MicroStrategy like it's some kind of modern era economic sabotage. And if that sounds exaggerated, I get it. It sounds dramatic. But then you look closer, and it's not that far-fetched. MicroStrategy, if you're unfamiliar, is basically a publicly traded wrapper whose main objective is to take every available dollar, convert it into Bitcoin, and store it. If capitalism had a hoarding instinct, that company is the physical embodiment of it. And recently, something fascinating happened. Their stock price fell not due to operational collapse, not because their product failed, not because of bankruptcy risk, but because the market valued the company at roughly $10 billion less than the value of the Bitcoin it actually owned. Meaning, if you bought the company, you were essentially buying Bitcoin at a discount. Now pause there for a second, because that isn't just an oversight, that's a systemic pricing anomaly. It's like being able to buy a Tesla for $30,000 worth of stock, but actually picking up $40,000 worth of batteries included inside it. Everyone knows that's not stable. So when I first heard that claim circulating, that big banks were manipulating pricing, I dismissed it. I assumed it was just online noise. But then I started digging. And once you start pulling on threads inside financial systems, very often you discover something structurally bizarre underneath. And one concept kept appearing over and over again, the debt spiral. Or more precisely, the death spiral. Same structure, same outcome. And like many things, this isn't new. We've seen versions of it hundreds of years before Bitcoin, before stocks, before modern banking infrastructure. Let's zoom out. When empires fall, the logic is the same. In the late 1800s, the Ottoman Empire wanted growth. Growth requires capital. So they borrowed from French and British banks, but their debt was indexed to gold. This detail matters because when debt is denominated in something you cannot issue, cannot manipulate, cannot inflate, the lender has structural dominance and the borrower has structural fragility. Then 1,873 hits. One of the first global financial crises. Credit freezes. Rates spike. Liquidity disappears. Suddenly, the Ottomans can't roll over old debt. They can't refinance. They can't print gold. Their currency weakens, meaning measured against gold, everything appears more expensive, although in reality, their currency is just collapsing. And eventually, the system breaks. They default. And then comes part two of every sovereign failure. The lenders start governing the debtor. Not officially, not politically, mechanically. France and Britain force creation of the Ottoman Public Debt Administration, basically economic colonization. This office-controlled tax flows, revenue flows, and asset liquidation all redirected toward bondholders. So the empire becomes a machine whose primary function is not progress, not innovation, not infrastructure, not prosperity, but repayment. You could argue it was one of the earliest large-scale financial receiverships. And history didn't stop there. Fast forward, Greece, about a decade ago. Same logic. Borrowed in euros. Couldn't print euros. GDP shrinks. Debt burden expands. Borrowing costs spike. Default risk triggers external intervention. Then came the Hellenic Republic Asset Development Fund. Sounds harmless. It's not. It was a liquidation mechanism. Core national assets were reclassified as inventory to be sold. Not negotiated, not optional. Necessary. That's the death spiral. Debt demands cash asset liquidation. Liquidation weakens the nation. Weaker nation means lower credibility. Low creditworthiness means costlier borrowing. Costlier borrowing accelerates liquidation. You see how it closes on itself. Systems like these eat themselves. Now, what's interesting, maybe uncomfortable, is that the same incentive structure exists in companies. Zoom forward, early 2000s, tech startups, biotech companies, internet companies pre-revenue. They need capital, but traditional lenders don't want to participate. Too risky. Enter specialized financing vehicles called PIPEs, private investments in public equity. Sounds harmless. Some were harmless, but some carried a term you probably wouldn't design into any sane system. Floorless convertible debt, meaning the lower the stock price went, the more shares lenders would receive upon conversion. So if you are the lender, you now benefit from the stock dropping. And if something benefits from something falling, eventually someone ensures it falls. This wasn't theory. It became operation. Lenders shorted the stock. Stock fell. Conversion yielded more shares. They sold those shares. Stock fell again. Conversion yielded even more shares. This self-reinforcing loop triggered collapse across hundreds of publicly traded companies. The SEC ran a study around 2001. And the results? Investors who held these companies lost, on average, 34% of their investment within 12 months during a bull market. Even worse, half of those companies didn't survive. About 48% were delisted, meaning once that spiral activates, survival probability decreases exponentially. And what caused it? Not fraud, not poor management, not product collapse. Just incentives. The idea that if a structure rewards destruction, the market will engineer destruction, which leads back to modern markets. The parallel MicroStrategy isn't a normal company. It's not even pretending to be one in the conventional sense. It is mathematically resembling a synthetic Bitcoin trust. You could say it's a company stapled to a vault. And inside that vault is roughly 650,000 Bitcoin, which at market value swings between $55B, $60B, depending on the week. But here's the twist. Against that, they owe roughly $16 billion, which sounds high in isolation, but relative to their asset pile, it's small. They call it LTV, loan to value, roughly 11%. Conservative, stable, safe looking. If everything stays stable, but the debt has terms, and the terms demand ongoing cash output, roughly $800 million per year, just to keep the machine lubricated interest. Interest equivalent structures, cash distribution to preferred holders, and preferred holders cannot be skipped. This is not optional dividend. This is a payable obligation, meaning MicroStrategy is legally structured as a yield engine for other participants. So where does that yield come from? Not their software business. That business is healthy, but not printing hundreds of millions in free cash flow. The answer is they built a reserve, a cash reservoir, roughly $1.4 billion currently. So what does that mean? It means they have, at current burn rates, about 21 months before that reservoir dries. 21 months before obligation meets the wall of mathematics. Now, this is where the structure becomes interesting, because above a certain valuation threshold, what they describe as MNAV is greater than 1, the system behaves sustainably. MNAV just means market value of the firm divided by the value of the Bitcoin it owns. If MNAV is greater than 1, the company can issue stock sell equity, raise cash, refill reserves, continue purchasing Bitcoin. This is a positive flywheel, a machine that grows, but in MNAV is less than 1 conditions. Everything reverses polarity. In MNAV is less than 1, issuing stock becomes irrational, because selling stock valued at a discount to Bitcoin means selling $1 for 70-90 cents. No rational allocator does that. So instead, reserves deplete, 21 months evaporate, and after that, they must sell Bitcoin. Selling Bitcoin lowers price both of Bitcoin and of the company. Lower valuations compress MNAV further. That triggers more selling, and you get the same structure the Ottoman Empire experienced, Greece experienced, and flawless convertible companies experienced a structurally accelerating liquidation. So when people look at this from the outside, they simplify it and say, well, that means if MicroStrategy ever has to sell Bitcoin, the price collapses. But it's not that simple. The real risk isn't even the selling itself. The real danger is the speed of expectation collapse. The moment markets believe a liquidation is inevitable, the price begins falling before any liquidation actually happens. Markets don't wait for events. They price in predictions of events. They price the idea before reality even gets near it. And that's what actually causes spirals, feedback loops of anticipation. The equity markets operate not on truth, not on evidence, but on narratives that become consensus. A single whisper becomes a self-fulfilling prophecy. Someone publishes a research note, someone attaches a probability model, someone goes on television and says refinancing risk increases beyond Q2 of next year. Someone else decides to short it, not because they believe anything is wrong, but because they believe enough people now believe something is wrong. Momentum feeds momentum. And before you know it, you have an ecosystem trading against a system, not because it's broken, but because they think it might break. Now imagine you're a hedge fund. You're not emotional, you're not ideological, you don't care about Bitcoin's philosophy, its decentralization, or its moral arguments. You just see an imbalance. On one side, a company that owes hundreds of millions annually. On the other side, a finite asset priced by sentiment. So what do? You test the equilibrium. You lean into it. You try to break it. If pushing something down could force selling later, then pushing it down becomes profitable now. It's not conspiratorial thinking, it's arithmetic. And that's why people online start speculating about bank involvement, because banks have millions of tools to create downward pressure in subtle ways that don't show up in conspiracy-style accusations. They do it through structured instruments, through research coverage, through index weighting revisions, through liquidity bracket adjustments, through fund allocation signals. None of these actions are illegal. None of them are coordinated. But collectively, they influence sentiment, and sentiment influences valuation, and valuation influences obligation. People think manipulation is one coordinated phone call. It's not. Real manipulation is when a bunch of independent players all pursue incentives that accidentally align. No boardroom meetings, no smoke-filled rooms, just economics unfolding like gravity. When the reward is the same direction, the market behaves as though there's a secret plan, when in reality it's not a plan at all, it's just emergent behavior. Now, let's flip perspectives. Imagine you're Michael Saylor. You've built this enormous financial engine. You've convinced the world to treat your company like a Bitcoin amplifier. You've positioned your equity as a derivative of scarcity. You painted a vision in which MicroStrategy becomes a container for monetary energy, and people still don't see it, but structurally MicroStrategy is not a Bitcoin buyer. It is a Bitcoin multiplying mechanism. The structure takes dollars, converts them into Bitcoin, issues equity at a premium relative to the Bitcoin acquired, and then buys more. It is engineered to compound a finite resource faster than normal accumulation. But here's the paradox. His system only works if the market believes it works. The belief is part of the machine. The confidence is part of the liquidity. That's not fraud. That's how capital markets behave. Even pension funds work this way. Insurance companies work this way. Every fiat currency in the world works this way. Belief determines demand, and demand determines survival. That's why when you see MicroStrategy trading above the value of the underlying Bitcoin, people think it's irrational, but it's not irrational. The premium reflects belief in future acquisition, future aggregation, future velocity. The premium represents the value of expansion. Investors aren't buying Bitcoin. They're buying the factory that turns money into Bitcoin at scale. Now imagine that premium collapses. Suddenly, the factory cannot operate. Suddenly, the ability to issue equity evaporates. Suddenly, the cash reservoir starts declining. Suddenly, 18 months becomes 15, becomes 12, becomes 8. Suddenly, the question isn't how much Bitcoin MicroStrategy owns, it's how fast they might need to liquidate it. And if that event comes, it will not be one dramatic day of announcements. It will be progressive pressure. Selling performs like erosion, drip by drip, until something structurally cracks. So when people online ask, who's behind this? What they're really asking is, who benefits from putting stress on this mechanism? And the answer is not one entity. It's not a villain. It's not a secret banker council. It's anyone who believes that applying pressure today might force selling tomorrow. Force selling tomorrow means cheaper Bitcoin. Cheaper Bitcoin means accumulation advantage. That is the entire incentive loop. Now, the irony is incredible. Bitcoin was invented precisely to escape a world driven by debt obligations that spiral. It was invented because governments keep creating liabilities that exceed productive outputs. It was invented because fiat money is inherently incentivized toward erosion. Yet here we are watching an organization apply fiat-style leverage to accumulate a non-fiat asset, and people are shocked that it carries systemic fragility. That's not a conspiracy, that's symmetrical logic. People think Bitcoin is immune to systemic risk. It isn't. Its code is immune. Its supply is immune. But its price is still exposed to the behavior of humans. And humans run companies using debt. Humans create refinancing moments. Humans create liquidity windows. Humans respond to incentive structures that don't care about philosophy. So Bitcoin has purity in its design, but vulnerability in its ownership structures. That is what most people misunderstand, because companies don't hold Bitcoin the way individuals do. When an individual buys Bitcoin, they are not contractually obligated to sell it later. They are not required to produce yield. They are not subject to redemption schedules. They do not owe capital distributions. They don't have mandatory payout milestones. Time is their ally. With corporate ownership, time is a liability. Time creates payout pressure. Time creates rollover deadlines. Time creates refinancing cliffs. So when analysts talk about refinancing risk, they're not using scare language. They're pointing at the function that converts time into vulnerability. It is the temporal hazard zone. Now, with all of this, people keep asking the same question: how long can MicroStrategy operate without selling any Bitcoin? And yes, mathematically, it's about 21 months from now at the current expenditure rate, but that's the wrong question. The right question is, does the market believe MicroStrategy can maintain MNAV above 1? If yes, this machine persists indefinitely. If no, the countdown accelerates. Markets price belief before outcome. That's why all of the tension exists today, not 21 months from now. Everyone is trying to front-run outcome. That's the game. And now, enter the banks. Think about their incentives, not their motives. Banks don't care about Bitcoin because Bitcoin isn't profitable in the way lending is profitable. Bitcoin removes counterparty revenue. Bitcoin removes spread revenue. Bitcoin removes interest revenue. Bitcoin removes maturity term structures. Bitcoin removes credit creation. Bitcoin is the anti-bank. So if a bank can buy Bitcoin indirectly through forced liquidation and obtain a lower cost basis, why would they want to raise the price prematurely? If you are a firm whose entire business model depends on arbitraging inefficiencies, you want inefficiencies to continue. You want tension to maximize. You want price divergence to widen. Because the longer the market disbelieves, the greater the gap between value and availability. People misunderstand institutions. Institutions don't invest early because they believe deeply. They invest early because someone else will eventually believe deeply. Institutional returns come from asymmetry, not conviction. Now, is there proof that banks are shorting MicroStrategy? No, not directly, not clearly. But proof is the wrong thing to look for. Banks never show proof. They express opinion. They issue research notes. They downgrade risk ratings. They shift index allocations. They publish long-term valuation ranges. They influence perception legally and openly. That's how power works in public markets. You don't need secret manipulation. You need sentiment shaping. And when sentiment shapes forward pricing, that pricing shapes survival. Now look at the other side. MicroStrategy is not helpless. They hold a massive monetary resource that theoretically should appreciate faster than liabilities expand. They have leverage that strengthens if price rises. They have call options embedded in growth. If Bitcoin reaches escape velocity valuation, every structural weakness flips to structural supremacy. But here's the uncomfortable part. No one wants to allow them to hold that position uncontested. If you let this model succeed unchallenged, MicroStrategy becomes the first publicly traded monetary accumulator. They become the largest capital formation machine tied to digital scarcity. They become the prototype that every future corporate treasury will try to mimic. And if that happens, financial institutions lose their monopoly on money creation, because the moment corporations collectively decide that storing value in Bitcoin outperforms storing value in fiat reserves, the banking system becomes a facilitator rather than an issuer. For banks, Bitcoin isn't just a threat, it's disintermediation. So imagine you're inside a financial institution. You don't need to sabotage Bitcoin. You just need to slow down its acceleration. You slow acceleration not by attacking Bitcoin directly, but by attacking mechanisms that accelerate accumulation. MicroStrategy is that mechanism, so maybe no one is attacking anything. Maybe it's just rational actors behaving rationally. But even rationality has emergent consequences. And this is the part most people don't want to accept. Markets do not care about innovation. Markets care about arbitrage. Innovation comes afterward, funded by arbitrage cycles that temporarily exploit inefficiencies. And everyone watching says, why is Bitcoin not at $200K? Because someone benefits from the delay. Because someone profits from stagnation. Because someone accumulates during disbelief. If Bitcoin were priced at universal agreement value right now, growth potential would vanish, accumulation advantage would vanish, marginal upside positioning would evaporate. People believe markets want truth. No, they want asymmetry. And asymmetry exists most abundantly right before consensus arrives. Now, if MicroStrategy survives the timeline window, if they sustain MNAV above parity, if they extend their runway, if they refinance elegantly, if they maintain confidence, their structure is not fragile, it is unstoppable. Because the longer they hold Bitcoin, the lower their relative cost basis becomes. And as cost basis declines relative to upward movement, obligations shrink in weight. But imagine the opposite. Imagine a market that pushes valuation below parity. Imagine 21 months shrinking into 12 due to operating stress. Imagine 12 becoming 8 due to widening discount. Imagine forced selling at scale. The liquidation would not only harm MicroStrategy, it would fracture confidence in corporate accumulation as a concept. And the industry would move backward a decade. And here's the real paradox. Both outcomes are possible. Both are rational. Both can be pursued profitably. And no one knows which equilibrium will win. So the question now becomes, is this a system being attacked or a system discovering its fragility? Or is it simply a moment in time when mathematics reveals that different groups profit from opposing outcomes? Do we root for acceleration or delay? Do we prefer scarcity to be acquired broad or concentrated? Does forced selling harm Bitcoin or create the cheapest entry point since institutionalization began? And if price suppression creates mass adoption later, was it sabotage or was it incubation? What matters isn't what MicroStrategy does next. What matters is how incentives align around the belief of what they might someday be forced to do. And that is where the narrative shifts from finance to something more philosophical. So now we're in this strange moment where the future is undecided and everyone is trying to pretend they know how this resolves. But uncertainty isn't a flaw. Uncertainty is actually the pricing model. Uncertainty is why there is yield. Uncertainty is why there is asymmetry. If everyone already knew the ending, then all of the rewards would already be priced in. There would be nothing left to earn. So the current tension around MicroStrategy and Bitcoin is not an error, it's the incentive engine doing exactly what it's designed to do, reward people who see before others see. People keep asking whether Bitcoin is still undervalued. But the better question is, undervalued relative to what timeline? If adoption curves flatten, then perhaps Bitcoin today is fair value. If sound money transitions happen faster than expected, then today's price looks primitive. It's impossible to price something that operates on exponential lag cycles. People think they understand compounding, but psychologically they don't. When something compounds slowly, humans ignore it. When something compounds too fast, humans call it madness. There is no comfortable middle. That's how innovation works. And when you look at MicroStrategy, that's what you see. A company trying to compress the future into the present. They aren't trying to hold Bitcoin academically. They're trying to hold it in a time lane where adoption outruns dilution. They are front-loading scarcity. And that is a dangerous idea, not because the idea itself is wrong, but because executing it requires holding tension longer than the market believes the structure can tolerate. Some people think Michael Saylor is reckless. Others think he is visionary. But those are emotional interpretations. The truth is more mathematical. He placed a long-dated asymmetric bet. If Bitcoin becomes global monetary standardization, his accumulation window will never repeat. If Bitcoin does not, then the strategy collapses. That's not optimism. It's structural exposure. You either believe time strengthens the asset or time decays it. There's no in-between. And that's why people argue banks want Bitcoin suppressed. Because if Bitcoin gets expensive too soon, accumulation opportunity ends. Institutions don't chase disruption, they arbitrage inefficiencies. They wait until the upside becomes safe, not when the upside is maximal. They operate when uncertainty transitions into inevitability. And by definition, when something is inevitable, the upside is reduced. So in a way, today's price stagnation is the exact signal of tomorrow's involvement. If Bitcoin were already universally accepted as dominant monetary infrastructure, the price wouldn't be $60,000, it would be $500,000, probably more. And everyone who waited would have been late. Institutions would have no edge. Legacy capital would be neutralized. That's why price lag exists. Price lag is not malfunction. Price lag is the final gate before broad distribution. Look at it historically. The railroads didn't become dominant when everyone believed in them. They became dominant when almost everyone doubted them. The internet wasn't priced at full value in the 90 seconds because the world wasn't ready to know what it was. Electricity wasn't priced correctly until factories recalibrated their entire workflows. The moment belief catches up, upside disappears. Whole industries of arbitrage vanish. And Bitcoin sits right in that pre-belief tension. Now consider how MicroStrategy fits into that arc. They are either the first corporate entity to model treasury transformation and prove that storing energy inside a digitally scarce reservoir is economically superior, or they become the cautionary case study people reference in finance. Textbooks a generation from now. In both outcomes, the world learns something. But the world usually learns by watching someone take an outsized risk. That's how every monetary transition looks. Someone holds when everyone else doubts. That someone looks irrational, until suddenly it becomes obvious. Then their irrationality rewrites the baseline assumption for everyone else. But here is the part that people don't really appreciate. The success of MicroStrategy is not guaranteed even if Bitcoin succeeds. Because if market forces push the company into forced liquidation, the structural beneficiary might not be shareholders. It might be the buyers on the other side of those cells. Someone will get the Bitcoin eventually, but it may not be the originators. And that's how capitalism works. Ownership of value belongs not to the inventor, but to whoever can outlast constraints. And that is why short sellers exist. Not because they hate something, but because they believe they can survive longer than the structure they are shorting. It's not emotional, it's mechanical. Now imagine what's happening psychologically. Half the market sees MicroStrategy as a one-way lever into future digital scarcity. The other half sees a time-sensitive liability engine waiting for liquidity exhaustion. So one side buys not just Bitcoin, but exposure to leveraged Bitcoin accumulation. The other side attempts to induce timing failures, not because they dislike Bitcoin, but because they prefer Bitcoin cheaper. This is not morality, it's game theory. And this brings us into a deeper question. If people believe Bitcoin is destined to rise indefinitely, then isn't today's suppression just the reward for those who accumulate now? Isn't every negative headline, every analyst downgrade, every liquidity event, every forced selling moment actually a disguised advantage window, a final blueprint for wealth transfer? Markets rarely reward early believers with smooth compounding. They reward early believers through psychological discomfort, volatility, criticism, mockery, and uncertainty. You earn the upside by surviving the uncertainty. You suffer discomfort instead of paying higher entry price. This is why tension exists in all emerging asset systems. Now think about how the death spiral narrative fits into that. People assume if MicroStrategy liquidates, Bitcoin collapses permanently. But collapse is temporary. If Bitcoin is actually weak, collapse destroys it. If Bitcoin is actually strong, collapse decentralizes it. When scarcity transfers, ownership redistributes. So now consider if the system forces selling, who will be buying? Not retail. Retail reacts emotionally. Institutions will buy. Governments will buy. Corporate treasuries will buy. Family offices will buy. Wealth funds will buy. That is why structural suppression exists, not to kill an asset, but to transfer ownership. This is where the conversation becomes uncomfortable. Because what if the attack is not designed to destroy Bitcoin, but simply to remove it from the hands of the impatient, the over-levered, the poorly structured? What if this isn't sabotage, but filtration? People worry about price suppression instead of asking whether suppression is removing weak holders. And in markets, weakness doesn't mean stupidity. Weakness means time sensitivity. Weakness means needing liquidity. Weakness means high obligation exposure. Weakness means low patience margin. Weakness means solvency timers. Bitcoin doesn't reward those who want money fast. Bitcoin rewards those who disappear from time pressure. And that's why MicroStrategy is in the most extreme position imaginable. It holds an infinite duration asset with a finite duration liability schedule. That mismatch is either genius or fatal. But here's what's fascinating. If they survive the runway, they become structurally unstoppable. Because eventually liabilities finish, debt matures, dividends taper, notes expire. But Bitcoin does not expire. Scarcity compounds over infinite horizon. So if they reach escape velocity, they transition from vulnerability to indestructible balance sheet. But if they fail before that point, the Bitcoin flows elsewhere. So now what does success look like? Is success Bitcoin reaching $200,000 while MicroStrategy still holds their supply? Or is success Bitcoin reaching $200,000 because MicroStrategy was forced to liquidate, thereby redistributing supply to stronger hands who then stabilize pricing? Who actually wins? Is it the pioneers who initiate the strategy but cannot withstand time? Or the entities who enter when pioneers are forced to sell? Is innovation rewarded at the beginning or at the end? Historically, pioneers almost never keep the crown. The people who first commercialized electricity weren't the people who built global power grids. The people who invented search weren't the ones who monetized it. Visionaries signal the frontier. Consolidators harvest the frontier. And maybe that same dynamic is happening now. But then you ask the inverse question, what if this time execution survives long enough to hold the crown? What if, instead of pioneers collapsing, they endure? What if MicroStrategy actually bridges the vulnerability gap and exits the liability window with full treasury intact? That outcome is historically rare but possible. And if that outcome materializes, everything about corporate finance changes. Treasury allocation becomes strategic accumulation. Balance sheets stop deteriorating from inflation leakage. Companies stop storing purchasing power in melting assets. Imagine 500 companies storing value not in debt-based reserves, but in scarcity-backed reserves. Imagine every new earnings cycle redirecting free cash flow into digital scarcity rather than fiat liquidity pools. Imagine assets that rise while liabilities shrink in purchasing power. That would reverse corporate financial decay. If the cycle completes, MicroStrategy becomes chapter 1 of a new monetary textbook. If the cycle collapses, MicroStrategy becomes Exhibit A in why you must never outpace liquidity timelines. So now the question becomes personal rather than analytical. What do you believe survives? Time pressure or absolute scarcity? Because Bitcoin's outcome cannot be influenced. Bitcoin exists independently of MicroStrategy. Its protocol doesn't care about corporate refinancing windows. But MicroStrategy's outcome absolutely is influenced by Bitcoin's timeline. And the tension between those two timelines is what everyone is trading right now. So maybe the real question is not whether the death spiral activates. The real question is which timeline converges first, the timeline of scarcity recognition or the timeline of liquidity depletion. Money markets are betting that scarcity recognition arrives slower. Bitcoin holders are betting that recognition arrives faster. That is the entire philosophical battlefield. If Bitcoin finds universal pricing before liabilities mature, MicroStrategy becomes the largest corporate asymmetric success event in modern history. If Bitcoin finds universal pricing after maturity, windows choke liquidity, someone else ends up owning what they collected. So the final question, if we're honest, is not about MicroStrategy at all. It's about whether markets will understand what Bitcoin is before time runs out for the companies that tried to institutionalize it too early. And maybe the real ending isn't a number or a target or a price prediction. Maybe the real ending is a question. Do you think scarcity reveals itself faster than conventional finance unwinds? Because whichever answer you believe dictates what position you take today, and the future is simply waiting for someone to be right.